keep in mind, when we talked about that example that I used, a $50 million fund, you don't have any deals under contract yet. You're going to investors and saying, hey, this is our business idea. This is our track record. You probably have invested with us before. Now, come on in and invest in our fund, and we're going to do great for you, and we're going to achieve these economics that we're promising you.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Experiment Nation, this was a solid one. If you're looking at evolution, how a agent turned himself into a general contractor, then a builder, then had the big hairy ass goal to go into development, but then saw an opportunity by building credibility, not overnight, not over 1 month, not over 2, not over 2 years, not over 3, but actually earning his stripes in a craft for 15 years to build a brand, not just by starting a YouTube channel or having a LinkedIn, but actually knowing his craft, so that when the opportunity came as again, builder who was doing spec homes and custom builds, which he talks about the difference between the two, which I had no idea about. As he does this, he comes across an opportunity when he's always wanted a high riser, or what he's actually calling was not a high riser at the time, but it was definitely a commercial asset. He got into land assembly, and the reason why his partners gave him the green light is because he had the receipts to be able to do such a deal as a partner. When he then partnered into that, it segued into opening up the world that we know of multifamily syndication. But what's interesting is that this gentleman by the name of August, he actually goes in and lifts up the hood to show us what are the steps that it takes to get into this private institutional money that we see these big insurance, the Blackstones, the Waystar of the world are doing. And he kind of walks you through the trajectory of, again, his journey as a syndicator, and then talking about having a closed fund and then an open-ended fund, and then again, the opening up the door to the REITs, which would be kind of like that final step of getting up into the institutional. So first private equity, then JVs is how he started, then syndication, and then lo and behold, he opens up that door to his reverse engineering a 30,000 unit plus behemoth of an empire at CPI Capital. After having gone 200 million plus multifamily assets as a GP and as the co-founder of this company, I think it's interesting to understand the layers and levels that it takes to plant the seeds in your craft, in your credibility, to then be able to raise the capital, becoming the person that's able to do the thing, to then have the thing. If there's ever anything like it, to unpack what that trajectory might look like, not only can you take gems specifically untied to real estate, but lessons that will help you embark on your journey to be able to achieve the kind of level that he's achieved. And the best part is that he's just getting warmed up. I promised him that next time he steps on the show, we'll be having him as an investor that has real estate investment trust baked into his asset class, as the co-founder of and chief investment officer of CPI Capital. Without further ado, August Biniaz. There he is. Experiment Nation, Ruben, Kanya here with August. And August, before we hop in, actually, I always like to ask the origin. What is the origin of your last name and how do you pronounce it?
Iranian, Persian, Iranian. It's Biniaz.
Biniaz. All right, hold on. We're gonna have to pause this for a second because my parents-in-law are from Iran. They're Armenians originally.
Oh wow, cool. Yeah,
my wife is Armenian.
Okay.
So were you
Iranian Armenian, not from
Iranian.
Armenia, because there's a country of Armenia as well. But
so they're Armenians by blood, but they
Yes.
they came over after the
Yep.
revolution and everything. But
Yes.
obviously, there's a connection there. I didn't want to let the serendipity go to waste. Are you first generation or
I
were
am.
you
You
born
mean
there?
no? I was actually oddly enough, I was born in India, from all places in the world. But
No kidding.
I'm ethnically Iranian. My family was just there. My
Yeah.
dad was doing some business. My mom was going to school, and I was born there. And we went back to Iran when I was 4 years old, and then moved to Canada when I was 14. So,
Wow.
but yeah, there is a large diaspora of Armenians in Iran, close to our neighborhood in Iran, in Tehran. There is a
Tehran, of course.
community center, is an Armenian Iranian community center, and it's huge. And you can go there, and obviously in Iran, alcohol is there's a prohibition
Hmm.
against alcohol, but Armenians can drink as long as it's in their own facilities. So,
Interesting.
and the way you get into the community center, they ask you in Armenian, what time is it? And you have to respond in Armenian. That's how you get in. So, as
And
long as
so
you speak
do
the
you speak
language.
Armenian? Or
I'm not Armenian, but
no, I know you're not, but
yes.
do you
No, no, not at all. No,
Farsi?
most Iranians though don't speak Armenian.
Yeah.
Maybe some Turkish, maybe a little bit of
Mm.
Arabic, but not really. Armenian is not as common as other languages within Iran,
Yeah. Interesting. Yeah, there's a huge diaspora here in California, Glendale.
for sure.
As you probably know, right across from where you are.
Yes.
But that's such a small world.
Yeah.
Very interesting. So
Well,
Biniaz.
some celebrities as well, right? We're recording for the show, right? Just making sure right now.
Yeah.
Or yeah,
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 we're
perfect. Yeah.
vibing.
So I mean, the big celebrity is Patrick Bet David, who is also
Oh, I love
Armenian. Yeah,
Patrick Bet David. Well,
He's
it's
Armenian
interesting.
Iranian. Yes.
Exactly, because I believe his mother's Armenian and his father is uh Iranian.
Yes.
Yeah, or what? How does he say it? He actually was saying some other.
Persian Iranian.
No, no, it's Iranian. I'm just.
Yes.
He said like a different like dialect. I remember I was just listening to him the other day, and I was like, oh yeah, that's right. I remember that. But yeah, he big entrepreneur, big fan of his. He's done some amazing things with PHP. I actually learned a lot from his model as well, his agency model, because we have a brokerage agency that we build. So I really like what he's done for himself. Yeah, that's interesting. Are you a fan of him?
Yeah, I'm pretty. I'm more on the political view about Iran. He's a monarchist. I wouldn't say
Hmm.
I'm a big monarchist. I'm more of
Hmm.
a uh, democratic nationalist for
Hmm.
what I want for the future of Iran. I'm definitely
Yeah.
not an Islamist,
Mm.
which is the current regime in Iran. But he's a very hardliner monarchist. So I'll be
Yeah.
open to the Iran monarchy coming back, but
Hmm.
it needs to be a constitutional monarchy. So parliament and everything else.
Yeah, it's interesting because he's shifted over time. I've seen him shift into heavily into politics. I know that was one of his passions before. It was very entrepreneur. Now he's gone. I think he might be making a move for his sons to be in office. I think that's one of his goals. I'm just putting it out there.
Yeah, no, for sure. Why not?
Yeah, yeah. Very good. Well, listen, look at this serendipity. You know what's fascinating as we transition into your story, because we got some background. When we first connected offline, we realized that there's a little bit of a Canadian connection, which is really cool. And then we got a little bit deeper, and now we have some middle, I guess, Eurasian roots that and connection there as well. So it's such a small world, but how we connected officially is, of course, you have a fascinating real estate background as the co-founder and chief investment officer of CPI Capital, and I know you and I were talking about your experience or as a thought leader in the space, and what you're able to do, which I'm interested in this, in this economy and this times with the multifamily as a syndications, you being from Canada as well, talking about that and bringing your talents over here, and possibly love to hear if you've indulged into the Canadian market at all, and if not, why not? I think there's I think you'd be more than qualified to talk about that, but just to even peel back the onion and zoom out for a second, right? I do it. We just got back from another a nice trip recently. We were with some partners in Nashville. We spent a lot of time in the airports. One of my favorite questions that I like to open up is if you and I are sitting down together on a plane and I introduce myself and I ask you, August, what do you do for a living? Speaking with the thought leadership that you have and all that you've done, What is your opening line to open up the lines of communication? What do you open
I'll
with?
give you I'll give you more of a litigious type of answer, more of a
Mhm.
lawyer response. It really depends on the audience, I would say.
Yes.
At
Smart.
times, people in finance, in private equity, in real estate could convolute the conversation where you lose an audience. So it really depends who it is. I mean, on if I want to really simplify it down, is I would say, hey, I'm in real estate, and a lot of people right away they translate that into a real estate agent because their real estate agents are very common. So it's, oh, you're a
Mm.
realtor, oh my son or my cousin or my friend is a real estate agent or what have you, and then I have to bring the conversation back and explain to them that I'm not really on the brokerage side. I'm more on the investment side. And then the next question is, oh, they right away think about me as a real estate investor, that I buy real estate myself and what have you, or my family. And then I have to continue the conversation saying, no, I actually manage an investment firm that partners with investors and buys real estate. And then if the conversation gets deeper, what type of real estate, how do we raise that money, and what is it in for the investors, and so on. If the audience is a bit more sophisticated, I could simply just say real estate private equity. Um,
Mm.
if the audience is middle ground, they're not super academic, and they're not super sophisticated, then I might say something as, I'm in real estate investments. Look at us as your regular fix and flippers, but rather than fix and
Mhm.
flipping in a house or a condo, we fix and flip large apartment communities. And the money that we need for the project mostly comes from the bank, but the down payment and the money needed for the projects comes from a group of investors that we raise money from. So it really depends on the audience. What is it that I do? But it could be a complicated elevator pitch, but trying to refine it still over time. So I always look at my audience.
Yeah, it's so funny that you say that because, recently we were just at a wedding and I met a private equity guy, but he was a, family office, multifamily office. And so we really had a great chat about that because it's something I love, that the topic. I think I recently went to right in my backyard here at Harvard was talking about a lot of the family offices in business and these long businesses who have been, passed from generation to generation. And so we kind of unpacked that conversation. But when you say private equity in real estate, we've heard of syndications. I don't hear too many people use that. I think it's a sexier term. Can you enlighten us on, what the real estate private equity firm that you've built does, and how do you get to 200 million plus in assets? How does that work? You kind of talked about it, the, leveraging the banks and then possibly some private money with some of the down payment. Do you want to unpack that?
Yeah, absolutely. So, I mean, the real estate finance lexicon is pretty broad, and it could get complicated and convoluted at times. But yeah, when we're discussing real estate private equity, it's important to take a step back and discuss what is private equity itself, because it gets confusing at times. And private equity is basically a business model that was created in sometimes in the 70s, 1970s, and it was a business model to raise capital from private investors. In the case of private equity, they're institutional private investors, meaning these are pension funds, family offices, university endowments, sovereign wealth funds. The reason they're called private is because they're not on Wall Street. They're not on the publicly traded company. So
Mm.
historically, when you want to raise money, you go through the public route, you go through an IPO, and you raise money from that through that process. But private equity is a process to raise capital from private institutional investors. And the business model historically, initially, was to buy companies. You raise money to buy companies. Now, the company could be publicly traded. The company could not. So the business model could be taking it off the stock market. The business model could be taking the company public by any means to make the company more efficient. And some of the early companies that utilize private equity or KKR, Apollo, and then
Mm-hmm.
later on Blackstone, which Blackstone was using a business model which was leverage buyouts. So they would, there's a couple of great books on the topic, Barbarians at the Gate and King of Capital, that
Mm.
discuss the rise of Blackstone. And now today, Blackstone is the largest private equity firm in the world. But at some point, Blackstone being opportunistic investor, they realized there was an opportunity in real estate investing. So they started raising funds and buying real estate, which was a spawn of real estate private equity. Now, their model is usually the fund model. So Blackstone puts together a $10 billion fund. Not too long ago, they put together a $10 billion fund to go and buy real estate. So the minimum check size, I believe, is like 50 million or 100 million that comes in, and they raise that fund and they go out there and buy real estate. The syndication model is a smaller model of the same type of business. Just going back again on private equity, the way that private equity managers, or in the case of the world of finance, they're called general partners, the way that they get compensated is through two set of fees, really. They're called performance fees, management fees and performance fees. So management fees really come first, but management fees and performance fees, the management fees are usually 2% of the fund, the total fund raised, 2% of the fund per year, per annum. And then the performance fee is usually 20% of the total profits that the fund makes when the fund is wrapped up and divested. So the world of real estate private equity, or the world of syndications, or even funds, they utilize basically the same models, the same road that was paved by private equity to do the same model. So when it comes to CPI or other investment firms, they use a similar type of vehicle. There are two main models to use when you want to raise money and buy real estate. You could buy anything really, right? But let's focus on real estate. So you could do a syndication, which what it means is really a project specific fund, a one deal, basically. The sponsor, the general partner, the manager, and these are all really synonyms. They find a deal, the deal really makes sense, they put it under contract, and then they go and put together a single purpose vehicle, be it an LLC or a limited partnership, and then they go and bring on their investors. Their investors only have exposure to that one deal. The deal is being managed. There's a compensation structure charged by the general partner, and that's how the deals are done. That's in the space is really, that's what's called syndications. That's what commonly known as syndications. Now, funds, similar to Blackstone and large private equity firms where they put together funds, the similar vehicle, a limited partnership or LLC, can also be used as a fund. But in this case, there's no longer just one deal. The fund really behaves like a basket of deals. So let's use an example of a closed-end fund. You can have open-ended funds or a closed-end fund. In the case of a syndication, you buy one deal, you execute your business plan, you exit, the investors take their profits, the GP takes their profit. In the case of a closed-end fund, the fund has a mandate. For example, the fund's mandate is to buy multifamily properties built in the 80s and the 90s and 2000s in Tampa Bay, Florida. And the fund is a $50 million fund, and the fund's lifetime is around 10 years. So the first year or two, the fund is going out there and is raising that $50 million. Over the next few years, the fund is executing the business plan, is buying the deals, doing whatever the business plan was. And over the last few years, the fund is divesting the deals. So the fund gets wrapped up and the funds are returned back to the investors. In the case of go ahead.
I was going to say, can I ask you a question? Because one of the things you mentioned, and I love the direction you're going in. I typed in Blackstone real quick, and of course I'm familiar with Blackstone, but then you put it into context, right? You know that they have a real estate vertical, but then you look, they have credit and insurance, like multi-asset investing, infrastructure, life sciences, growth. I mean, you're talking about so many sectors just by even landing on their website. I heard you say one thing, and I want to make sure it doesn't slip through the cracks. When you have a fund, how much of that can be solely focused on, hey, this is just a real estate fund versus this is a fund that has real estate and life sciences and energy. Is it typical that a fund is an umbrella of the same asset class perhaps, or could you also have like a fund that's also diversified and that has multiple different asset classes or maybe even sectors?
Yeah, I really answer that question in two real ways from two different angles. First angle is, as long as a fund's offering documents, their information they're providing to their investors constitutes that they can invest in anything they wish, is a very broad mandate, then the fund can do whatever it wants. At the end of the day, is as long as you've done the reporting to your investors, as long as the investors know that they're getting into a fund that has a very broad mandate, then the fund can do whatever it was. Is it normal practice for their fund to be very diverse in its business plan? It's not. So when Blackstone puts together different funds, the funds are specifically for that business. So if it's got a debt fund, creates a debt fund. If it's a real estate multifamily fund, it does a multifamily fund, a
Okay.
BTR fund. So the funds are, or life sciences, or the data centers. The fund is dedicated to that business plan because the fund has a fund manager, has the executive team members, has his own mandate. So,
Sure.
so
Okay.
two ways of looking at it. One, yeah, legally you could, as long as your offering document says so. But does it really make sense for a fund to be that diverse in his mandate?
Probably not. Got
Probably
it.
not.
Okay, so that's helpful. And you mentioned closed-end fund. Is there an open-ended fund? I wasn't really
There
clear.
is. Yeah, I was just
What's
getting to
the?
that. So,
Okay,
yeah,
got it.
open-end
I'll
fund
let
is
you.
basically a vehicle that gets created, most probably a limited partnership, and
Mhm.
its mandate is to continuously raise capital and continuously deploy that capital and buy deals, and the deals gets rolled into the fund. At times, deals get divested, so it doesn't have a time horizon, and investors can also come in and out of the fund when they wish. So. That's more of a NAV model, which is net asset value. So the net asset value of the fund is assessed on an annual basis. So investors who get in early on in the fund, they might have better economics than investors who get on later on, and so on. And as the fund grows, it doesn't just dilute investors or make it more more economically beneficial for some investors. So the NAV model it works similar to like a publicly traded
Yeah.
REIT, where the price of a REIT goes up, fluctuates. Same kind of idea in an open-ended fund. But yeah, these vehicles can really be structured in any way. The advice for newer groups trying to get into the space is probably a step before a syndication or a fund or an open-ended fund is probably doing a joint venture. It's a lot less regulatory, um,
Less
you know,
paperwork. SEC
less
is not
paperwork.
involved, right?
Exactly, exactly. In most cases, SEC is not involved. It's a joint venture. You raise money from a few of your friends and business associates, and you do a business deal. You build a track record, and next after that, you do a syndications where you have offering docs, and you can go to the members of the public as long as you're using a certain correct exemption. And then when you've done that a few times, then you can go and launch a fund. Because keep in mind, when we talked about that example that I used, a $50 million fund, you don't have any deals under contract yet. You're going to investors, probably some institutional, because it's going to be hard raising 50 million from retail. But you're going to investors and saying, "Hey, this is our business idea. This is our track record. You probably have invested with us before. Now come on in and invest in our fund, and we're going to do great for you, and we're going to achieve these economics that we're promising you."
Yeah. Yeah. No, it's very, very interesting. I gotta ask you, we're gonna backtrack a bit because I want to rewind the clock a little bit and understand for someone who's listening, super interesting. It's not something you just jump in right away, but you did have to start at some point, or I should say it is something you jump in right away. You don't start doing a 506, C or B right away, perhaps, but what is that transition that you took to now be in a position where you have hundreds and millions of assets under management with your firm? What was your first initial leap and why did you take it?
Yeah, no, great story. I mean, for me, I was in real estate most of my professional career.
Mhm.
I was a real estate agent for a short stint. I was a general contractor, and I became a home builder for close to a decade. I was building both custom and spec homes. Custom is when a client hires you and you build them their custom home, and spec is when you build a home and you put it on the market, hope to sell it for profit. So I was doing both of that for a long time. Always wanted to
Which one is
scale.
easiest, by the way? Just curious. Which one is, I shouldn't say
It
easiest, but which
depends.
one did you like more?
It depends. On a custom home, there's no upside. You're building for a fee. A spec home, there's upside. You're taking risk with the market, and if the market does well, you make a lot of profit. If it doesn't, you're gonna have some losses. Whereas as a custom home, you're getting paid no matter what. You're basically acting more like a real estate
Well,
agent who gets paid no matter what.
why do you say that? I don't think I'm following. Why do spec homes um get more upside? Is that what you said?
Yeah, so like in the case of a custom home, as a builder, I'm just a service provider. A client hires me, I build them a
Mm-hmm.
home. They can do whatever they want with the home. They can move into it, they can sell it, they can do whatever they want. I'm just a fee-based service provider. In
Mm.
the case of a spec home, it's either my own investment or some partners or some investors have brought into it. So I have vested interest. I have I have skin
Mm.
in the game as far as how the deal is, how well the project does when it's sold. So if it does well, the market does good, and we've built a good product, then we can make profits. If it doesn't, and the market kind of slows down, then there could be possibly losses. So in that
Okay,
case,
so
the
it's
builder is
almost like you're
acting.
partnering. Yeah, you're almost
Yeah,
like a partner on the deal, and you have vested interest.
yeah, but take out the owner of the home completely. In scenario A, there is an owner that owns the land, hires you to build a house, to do whatever
Sure.
they want. You're just a service provider. In the scenario B, you are the owner yourself.
Yeah, yeah, yeah. You have skin in the game. Things could be going down and you get impacted. So I guess as a builder, you would want to possibly diversify your portfolio, I'm assuming. Like you get a few fee based, you're like, oh, I got a few contracts in, I'm gonna get paid for the job. I don't own anything. I'm just delivering the product. And on the other hand, I might get in bed, for lack of better words, with some partners and maybe have some upside or maybe have some downside and risk, right?
Sure, it depends. Again, if you're in an upmarket like Vancouver was for 20
Mm,
years, you really want to
jeez.
be a spec home builder because the market
Yeah,
was
get the
just doing so
upside. Yeah.
tremendously well, like or Miami over the last 5 years. So
Mm,
you want to be a spec home builder. But if the market is not doing that well, and there's risk associated, then you want to be a custom home builder. So yeah, a combination of two, and that's very common in the space of custom home building. That a home builder, I should say, that they do both. They do both custom and spec for themselves. So I was doing that for anything else there before I go back
No, no,
into.
that was great.
Okay.
I appreciate you because you'll say certain things and it's second nature to you, but I'm like, I don't think I know the difference.
Please,
I want to
please,
make
yeah,
sure
no,
that
no,
you're enlightened
I
there. So
appreciate
you,
that.
so you started off combination of spec homes, some custom homes, and then
Then I had a deal that came across my desk. Now at this time I'm only focused on building single family, but I have dreams and aspirations to do bigger projects. I want to build a high rise one day, and I want to build this business. And a
that's like
deal
the
came.
upper echelons, right? Of like when you
Exactly,
think of like developer, it's like the
exactly.
big, like 100 unit. Okay, got it. So
Exactly.
that's where
And
you're
here in
targeting.
Vancouver, I saw that firsthand, and it was really, Vancouver is a very multicultural city, and there, we have all these ethnic backgrounds here,
100%.
Italians, Indo-Canadians as they're known, and you can see their growth over the years as well. Like some home builders from the 60s and 70s, Italians, that was the main ethnic group that was involved in construction. Now is more people from India, but back then a lot of Italians. And today, some of the largest developers that build high rises in Vancouver are Italian backgrounds, like the Accolinis, the Buccis, and the
Mm.
Bosas. Your well-known Italian last names who've that's what's really left from that generation. So yeah, that was kind of the dream, and I didn't really want there to be multi-generation. I didn't want wait 3 generations for my kids to be building high rises. So I always kind of dreamt of being involved and expediting this process. But a deal came across my desk. It was a land assembly. So that's kind of a more of a Canadian term where you can buy single family homes in a row on an arterial road, which allows you to then increase go to the city hall, change the zoning, increase density, and build townhomes, for example, or low
Wow.
rise. In the case of this project, it was a 5 lot land assembly, and we were able to build 20 townhomes on this project. Somebody had put this project under contract for 8.7 million, and they had put down a $250,000 non-refundable deposit, and another $250,000 deposit was due in a matter of 3 months. And but this individual had come to some financial hard times, and he brought me the deal. Now I'm not in the townhome development or a large developer by any means, but it was just an opportunistic deal that came across my desk, and I took over the contract. I took over the contract without having 8.7 million or even the
What's going through your mind then and at that point? Like you're just like, because I'd love to know how, like what when great entrepreneurs like yourselves take those kind of risks, what's the mindset? And maybe it's not a risk, and maybe it is. So don't let me put words in your mouth. But what did you see when that comes on your desk? Is there fear? Is there doubt? Is there I'm gonna figure it out because I always figure it out? Like what's going through your mind?
It's absolutely a risk, a huge risk for you to get involved in a deal you've never done before, take that type of contract on, and put potential litigation, potential loss of capital. I mean, so many things could go wrong, but it was just that conversation, that drive, that enthusiasm, that energy that was there, that I wanted to do bigger deals, that was there, and I took over the contract, and I went to some business associates that I've done business with over the years in the single family space, real estate agent, a couple of real estate agents, a couple other contractors. And I said, hey guys, I have this deal and we're making money on the buy. The deal is worth way more than what I have this thing under contract. It's just that we have 3 months to come up with this deposit. This guy also wants his 250 and he wants to get out, and we can easily build this townhome project that we can bring on a GC. I'll sit on the board. I'll advise it. I'll even put some of my own money in there. But I don't have the needed. I mean, we needed probably close to like $4 or $5 million to close on that thing. So they agreed. My partners agreed, and they jumped on board. And at that time, I had no idea about GPLP structure and private equity and syndications. So very elementary. So what we did is we just created a corporation. We put our shareholder agreements, which is your corporation's basically charter. We put that together, that whose duties and responsibility was what, and that August, for bringing the deal and putting everything together, he would get a piece of the upside. So I would get a percentage of the profits when the project was built and sold. And we put that into the shareholder agreements. That was kind of really my start in. It wasn't really a syndication. That was more of a joint venture, I would say, rather than a syndication. But it was kind of my first start in the space. It was kind of a big leap as well. But I fell in love with that model, with the model that finding the deal, bringing on the investors, managing it, and getting the piece of upside. So it was more of a performance-based compensation structure rather than just a real estate agent or a general contractor or a builder who gets paid no matter what and doesn't really participate in the upside. So I really fell in love with that model, and I really went down this rabbit hole of trying to learn more how these deals are structured, what is GPLP, how are funds put together, which was ended up being, it took me some time. Now, another interesting part, you talked about Canada. So yeah, I am originally from Canada, from Vancouver, and this deal that we're talking about was in Vancouver. So US real estate was never division or any idea. I wasn't even familiar with it. But when I started educating myself, watching a lot of YouTube shows and podcasts and reading a lot of books, most of that information was coming from the US. There wasn't a lot of educational content coming from the Canadian side, at least not back then, not 7-8 years ago. As I was gaining this information, I started learning about business models that existed in the US that were not feasible in Canada, like cash flow. Cash flow didn't exist on an apartment deal in Canada, and the type of growth that existed, and how large the market was. So that was really the impetus for me changing my vision, rather than becoming a Vancouver developer and building high rises one day, is to acquire US real estate, particularly multifamily. And then again, I looked around the space and I realized that there aren't a lot of companies in Canada that do the syndication model and allow Canadians to have exposure to US real estate, US multifamily in particular. And the ones that did, the handful of the companies that did, they had done tremendously well over the years. So that was really the spawn for me to co-found CPI and partner with a couple of great partners and put the company together.
Experiment Nation, you've heard me talk about how multiple investors across the nation are landing these lucrative midterm rental insurance contracts by making these small tweaks on the branding and marketing side. Especially if you're an existing short-term rental operator, there is a quick and easy shift that you can make with the right guide in place. And because we've launched a 2-day boot camp that not everyone could attend in real time, I've put together a recording where you can get all the materials and all the guides to focus on rebranding either your short-term rental business or your current midterm rental business, so that you can actually have the insurance companies reach out to you. And then day 2 is if you want to actually play offense, how you can reach out to them by listing on the right platforms, etc. If you're looking to get this MTR bootcamp so that you can start optimizing and you can start receiving these lucrative contracts that again provide less headaches, less turnovers, unlike the Airbnb space, you can start receiving inquiries today by having the right guide in place. So please go to Experiment realestate.com/MTR bootcamp, or click the link in the bio to make sure you get your hands on this midterm rental insurance bootcamp to fast track your way into landing these lucrative insurance contracts the exact same ways multiple investors have taken advantage of this unknown and untapped niche within the midterm rental umbrella. Can we unpack the partner part for a second? Why do you think, who are those partners, right? Like what relationship or even perhaps credibility did you establish with them for them to say, you know what, August, yeah, we'll do this with you? Or was the deal just so sweet and then you earn your stripes along the way? And B, what do you think they even picked up your call? Like what is it? And the reason I'm asking this question is so someone else can understand what it takes. I think that, we talk about everybody gets opportunities, but you got to be ready to seize those opportunities. But there's also work that happens behind the scenes before you're the person that people are willing to say yes to. So can you unpack that a little bit
For sure.
on who those folks were, and
Yep,
then why
absolutely.
you think they said yes?
And you're talking about the partners that I put together, that townhome development, not CPI Capital partners that we put
Yeah,
together.
exactly.
Totally
The
separate.
first,
Yeah, no,
previously,
absolutely.
like the initial
Yeah,
launch pad.
of course. Yeah, I mean those partners. I was in construction, development, real estate in some way or other for 15 years at that time. So I had built a brand for myself, built a name for myself in the space. Was very well known in my city. So there were people that I had done business with in the past, people that I had made a lot of money from building homes and being a GC. So that wasn't really that difficult. I had a much harder time later on when I started CPI, try to raise money from other people because it was a totally alien asset class. Whereas going to people and say, hey, there was a deal that came across my desk in my city, which was a suburb of Vancouver called Richmond. The story it really made sense for the investors and partners to come on board. So, yeah, I mean, again, circling back as far as answering your question, there were people that I had done business with either in the past or people that had seen my growth and had seen my performance in my local area. So it was very, very intimate and close, those people.
Interesting. You mentioned this, and this might go over some people's heads if we don't dive into it, because you've been doing it for so long that it might seem second nature. But you talk about building a brand and building a name for yourself. You're giving yourself, call it your 20-year-old self advice, or 25, whatever stage, maybe earlier on, and you're going back to the times when you started this. What did building a brand and a name look like, and what does that mean, and what does it look like, so someone can hear, okay, it's not just me having an Instagram handle and a Facebook page, like, but what does it actually look like to build a brand in your eyes before and then now today?
Yeah, the brand and the name I had built for myself as a home builder in the city of Richmond was totally different than what it eventually became, the marketing machine that we currently have around CPI and our executive team members and other team members. So it was very elementary. It was very archaic, type of the same thing you say, an Instagram page, a website, maybe a Facebook page, create content once in a while. It was very minimal. But the people that I had connected with at that time, it wasn't as a result of those marketing efforts that they connected with me. The name and the brand I'm talking about was just about my performance in the city, knowing the city officials, going to the city hall all the time, the service providers that provided services to me in the city, and the type of homes that I'd built and the records I had broken. Now, again, coming back, I think this is a very important question that you raised. But when I did start CPI, gaining all my experience from the being a custom home builder for a decade, knowing the difficulty was always equity, and the difficulty on raising equity was how to be able to connect with investors and having an investor database, which was the reason that when I went to my partners, I say we got to put a lot of attention and focus around the equity side of the business, and that means we have to put a lot of attention and focus around marketing, not only building a brand for the company itself, but building a brand for each of us individually, each executive team member. And becoming really thought leaders in the space, and not only to create content. Obviously, in this day and age, where there's so much content online, people are getting overwhelmed at how much content exists. If people can do a simple Google search on you and something doesn't come up, it potentially could raise some red flags, right? I mean, it's harder when you have a very generic name, but when you have a unique name, it makes things a lot easier. But above and beyond just the brand is also being a thought leader in the space. Now, the great thing about being a thought leader in the space is you're not only out there creating content, you're also learning every time that you have a new presentation. If you have a new webinar, if you have a new guest, if you have a run a podcast, that allows you to learn so many things and expand your mind when it comes to the space you're in, be it real estate or otherwise. So these days, building a brand, marketing is huge. I mean, I was doing a test with ChatGPT, and I was some AI, and I was asking questions about myself, who I am, and it was telling me who I am. And I was asking questions about more of a niche area where what are some Canadian companies that help Canadian investors invest in U.S. real estate, U.S. multifamily, and CPI was the top 5 companies, right?
Nice,
So
nice. That's always a good sign when AI picks you up in the search engine
yeah,
optimization.
for sure. One
Uh
last quick thing. This doesn't limit itself only to raising capital and real estate.
no, it's
This is
everything.
for any industry you're in.
Yeah,
Even if you're in medicine, if you're
yeah,
in services, doesn't matter what industry you're in. Marketing is a huge part of it, and then
yeah,
a step above that is being a thought leader that's out there actually teaching and giving back to their own community. So if you
yeah.
want to renovate your roof in your neighborhood, if you jump on YouTube and you just check to see what it is, and a guy pops up and he talks about renovating roofs in your neighborhood, there's a high chance you're probably going to hire this guy because he comes across as an expert. And even if he's not an expert, if he's just doing roofs and he's making videos, he's probably going to learn a bit about the business as well. So at
Yeah.
least that helps that
Yeah,
there.
no, I'm so glad you went there. One of the things I want to highlight that you mentioned, and everything is second nature, I'm sure now to you, but you're bringing up such good points. One is, and this is what I wanted to highlight because I think whoever's listening to this, when we talk about branding and marketing, they automatically think of the surface level, right? But what you did is you build what is called the credibility based on your results, right? And I think it's easy to try to skip that step, especially in this day and age without technology. Oh yeah, you can put some YouTube videos up, etc. But have you done the work? Have you worked within a, as an apprentice, or as a, with a mentor? And have you put in, like you said, 15 years? Like, did you put in the work where you understand, what risks looks like, what opportunities look like, what, problem solving looks like? Like, are you known in the space? And now we have technology as a catalyst to that. But what you're going back to as well that I love is the thought leadership, right? Like, does your name come up when there's a very specific thing or problem or opportunity, as I like to call it? Do people, who are the people that think of you first? That's a thought leader. And I really want to highlight that because I think it's easy to focus on, oh yeah, let me get my Instagram page up, LinkedIn page up, and not do any of the work, not ask the questions, not get the education, not actually be boots on the ground running, get the actual experience that then will allow you to actually have people that can trust you and are willing to lend you money because of the track record that you've actually established. And I think that sometimes, the hard work, I'm a little bit old school in that sense. In my generation still, I'm like, you got to do the work, man. Like, there's no shortcuts to this. And so I wanted to pull that out of you, and I think I got it. And I'm not surprised because that is what you had to do, right? It's not like this thing where you're putting in videos without actually having done the work. So
That marketing is definitely a compounding effect, right? You
yeah.
got to keep going, and it builds over time.
Yeah, 100%. So tell me, we fast track. So where now you have these new partners. So first your previous partners, track record, name, you kind of do a JV, right? For lack of better words, right? Now, what was that? You said it was that, I forget the community name you called it, that it's a special name. You said it, the multiple homes in this. What that was the first deal that you
Oh,
did?
the land assembly, land
Land
assembly.
assembly. Thank you. Land
Yeah.
assembly. So you do the land assembly. What happens after that? And what was was it a slam dunk right from the get go, or was there some battle scars that came from that you took on to your next deals?
No, I mean, in real estate, you learn from every single deal. So yeah, there was
Yeah.
definitely lessons learned from that deal. But the deal had done great. I mean, it took a really long time for the project to be built because
How
just
long?
the Um, to be honest with you, we're just finished building it now. So it's taken
No
close
way.
to, yeah, it's taken close to 6 years to build that project. So that the majority of that time was due to the rezoning process and the
Mm,
entitlement, that it takes a long time. And that was kind of one of the draws to be able to be in the US, right, where things are much quicker, particularly in certain areas in the US, like
yeah.
in your Texas and Florida's, it's much more faster velocity for the entitlement process. So, but yeah, I mean, soon after that, after all the knowledge I gained about the opportunities that exist in the U.S., I co-founded CPI with a couple of great partners, and the mandate there was to invest in multifamily value add. And at that time, this data might be a few years old. Multifamily had done better than the S&P 500 over that 20-year period. And
Mm,
it was the second best performing asset class under the commercial real estate umbrella. Only industrial had beaten multifamily. In the U.S., you have over 100 million Americans that rent, and approximately 40 million Americans live in apartment communities. Now, around 5 million of that 40 million is living in A-class type of apartment community. They're more renters by choice. Well, you have around 35 million Americans, close to 10% of the population, that lives in uh, renters by necessity type of people that live in apartments. So it's a huge demographic that we're
mm,
serving, and we wanted so this old adage that there's always people always need a roof over their head. In that case, is really true because that number is growing in the U.S. and more people are becoming renters, not renters by necessity, but also renters by choice. A lot of people are renting, which is
sure.
this other asset class BTR that we can get into later. But yeah, the mandate was to allow our Canadian investors to have exposure to this asset class. And the next step was, how are we going to build the company infrastructure to be able to achieve this? Cross border hurdles as far as
Oof.
taxations across the border, bringing money, the compliance side. Not only you have to abide by U.S. security regulation, now you have to abide by Canadian securities regulation as well. Investor psychology between Canadian investors and U.S. investors. They think differently when they invest. The forex, the Canadian U.S. dollar changing back and forth today. The Canadian dollar is taking a huge dump, so it's fell a lot. Low numbers today. So I mean, it's very volatile. So how do you fix those numbers and so on? So yeah, I mean, it was, and then soon after, founding the company, COVID hit, which really shut down
Oh
everything
my
for a
God.
few months, and then the Fed had to print a lot of money to keep people satisfied, not to go to work, and that created exuberance and near hyperinflation. Inflation went up to 9% in the US, pretty close in
Mm,
Canada as well. And the central banks really have only one lever to battle inflation, and that's increasing rates. And they started increasing rates at a really rapid pace, going from zero to over 500 basis points increase in around the year, which was, it had an effect to the market and the real estate market in particular, the whole economy as well. But yeah, that's really where we find ourselves, when where there is some distress in the commercial real estate space. But yeah, we weathered the storm, did a bunch of deals. But I'll let you kind of get into more of it. I just that's kind of
yeah.
touching the
No,
surface.
it's interesting that, I mean, it sounds like going cross border has, I like to use the word challenges, which is an opportunity for Canadians. But I guess just to go back on you taking that, doing the land assembly in Canada, right? And
Yep.
then it sounding like the entitlements was kind of a, okay, lessons learned, things take a little longer. The grass sounds like it may have been a little bit greener across the border, but it comes with its own set of spices, or for lack of better words, or at least challenges. How much of that was a weighing factor versus, you know what, um let's do a couple more in our backyard here, or is there just simply not the right product that you're looking for, or opportunities? Like, how much was that weighing factor? Like, okay, we go across and now we have to factor in these things. How much was that was weighed into your thought process of going overseas versus you just saying, this is where I want to be, and I want to take advantage of all these other things and vehicles that I can on the US, and so that's where I'm set to go.
Yeah. Firstly, the grass was really greener on the other side. And in the profits, the yields were much more in the US. And the business model that we're trying to utilize, which was multifamily value add, where you buy a somewhat older apartment community, you renovate the units, and you better the tenant profile and so on, and you increase the net operating income, in turn increasing the asset value. That business model didn't really work in Canada, and the main reason behind that is that there is strict rent control laws in Canada in most
Mm,
provinces. And if every year that the tenancy term comes to an end in the US, and you can increase rents if you wish, or you can do some upgrades and increase rents. In Canada, you can't do that. You are, even in some states in the US that have very restrictive rent control laws, like California, at least you can increase rents by 5 or 7.5%
a
per annum.
percent, yeah.
Whereas in Canada, the max you can increase rents per annum is around 1.5 or 2% per year. So it's not even aligned with inflation, line of inflation. So it creates more dilapidated apartment communities. Investors and owners are not putting money back. And I've written an article on how rent control is actually a it's actually a negative for the real estate market, particularly on the multifamily side. So the business model wouldn't work. First off, the yields were much more in the U.S., and those high point of entries, those challenges that you quoted, that you mentioned, were actually an advantage for us, because if we were able to figure out the
Hmm.
ways to be able to allow Canadians to invest in U.S., and for them not to have to file U.S. taxes or deal with the IRS, for them not to be double taxed, for the process to be very streamlined. Now we had a competitive advantage. We could
Moat.
go to
You had
Canadian
a moat.
investors and say, hey, instead of investing in a debt instrument here in Canada and yield single digits, or invest in a public REIT, or investment in a real estate deal here in Canada, hoping to get single digit returns, come and invest with us, and we're going to try to achieve 15 to
Yeah.
20% average annualized return. So we took something
That's
that was,
that's
yeah.
that's also, and this is why I call challenges opportunities in business, right? That's really what it is. If you can reframe that and say, hey, if we can solve this, we've created essentially a moat where it's now a blue ocean strategy versus kind of competing with one. I'm just curious, and I don't know if you know this, and we don't have to turn this into a political segment because I have no interest in there, but there's got to be people in the government who look at this and be like, this isn't working. Like, is it? I mean, are we just that? Are they that behind? I mean, there's got to be some other ulterior motives. Like, why would you not, like you said, at least keep up with inflation when it comes to rent control in an asset class that contributes so much to the economy? Like, why would you want to have brain drain, as we call it, to have your top talent go to another country when you could keep it in? Like, do we know why, or if it's more complicated than that, and that's why I dare to not go into politics? Like, do we even?
No, no,
Is there a
no. Yeah.
reason?
I'll answer it a few different ways for you. One is that one of the reasons is Canada is one of the most liberal countries in the world. And when you talk about Vancouver, Vancouver is in the most liberal province of that country. And Vancouver is one of the most liberal cities of that liberal province. So there's a lot of left leaning ideas, and the mindset is really different than anywhere else in the world. Canadian politics, the most right-leaning Canadian politics still, which is Conservative Party, still falls on the left side of the Democratic Party in the U.S. So you have those aspects of it, which is more on the political side. But when you talk about municipal politics, which constitutes development and density, really, the constituents that are actually voting for the politicians, city councilors, the mayor, they are mostly the boomer generation, who've bought a home years ago, and their properties are worth millions of dollars. They don't want density, and they're the main people that vote. So if that density comes in, their property values plummet. So they're doing most of the voting. So they don't want density in their, basically NIMBYism. They don't want, not in my backyard. So that's another component of it. Next
Interesting.
is also when it comes to you know, development and taxation and the bureaucracy that exists. You know, like I was talking about deals in the U.S. I mean, we just got a deal entitled in San Antonio, and it took us 4 months to go through the whole rezoning and entitlement process. Take a piece of land from single family to multi housing. In the project that we were describing in Vancouver, it took us 3 years. I mean, imagine the cost of capital as that money is sitting idle, paying interest rate on an $8.7 million property. Now, even if you know, you're not doing 100% LTV, even if you do 70% LTV, that's 70% on $8.7 million. And if you're paying and land is much higher rate than a cash flowing piece of property, you're paying a much higher interest rate on that. So imagine how erosive that is to returns. So that's another issue. So it's a whole mechanism, is a whole industry, is a whole ecosystem that has to change for the housing to become more affordable in Canada. Another interesting thing in the US, in the commercial real estate space, one of the boogeyman that we're scared of is hypersupply. Oversupply, as is also known, is too much construction, too much housing, which results in too much supply, which results in the consumer having a
Lower.
lot of choice, and results in rent prices dropping and occupancies
Mhm.
dropping. We don't have that in Canada. There's never been oversupply, hypersupply. There's also been a huge number of immigrants that have been brought into Canada. I think over the last 15 years, we've had over 10 million immigrants coming into Canada. So they need housing. So that huge number of immigrants coming to a country. So we're just not building enough. The system is not made for it. Every new government that's come in said that they're going to do something special about building more housing. Cost of construction is higher. I mean,
Yeah.
they talk about this is getting really political, and it might be, you know, I'm not sure. It depends on how you look at it. You could, you know, take it a negative or a positive. But
Mhm.
one of the aspects of the U.S. to talk about illegals and ICE and what have you, a lot of
Mhm.
illegals work on construction sites, and it results
Mhm.
in very low construction costs for builders.
Yeah.
We were even concerned for our San Antonio deal that was there going to be, as a result, could some of our contractors use people without papers or what have you? Is that going to be, is ICE, was this whole thing that Trump has with immigration, was that going to cause an increased values or our project not moving ahead? Some investors were asking
Mhm.
as well. Thankfully, our developer partner was not using any trades or suppliers that had those issues. But on other sites, that wasn't the case either. But in Canada, you don't have that. So the construction cost is much higher in Canada than it is in the US, particularly when it comes to entry homes type of a home. On the luxury
Mm.
side, I mean, the price could go anywhere, right? But on the entry level, even though we're one of the largest lumber suppliers in the world, and we supply lumber to the US still, I mean, the price of construction is higher in Canada than it is in the US. Canada is the number one most educated country in the world. So immigrants that do come here are very highly educated. So you got engineers who are taxi drivers. So, you know,
I know.
so I mean, it's that's why the cost of labor is high here, and it, you know, it results, has a chain effect with cost of housing. So so many different moving parts there,
Yeah.
but
It
yeah,
it seems like it's appreciate you highlighting all of those because I'm not gonna sit here and say that's a push button fix, but it seems like there's an obvious way to address some of these challenges, and it just seems that obviously there's some ulterior motives as always, but nonetheless, it's, America's never looked when it comes from a multifamily asset class, it's never looked so greener, right? I think if you can get across some of these hurdles, it just I think those challenges that you cross border challenges or the benefits outweigh those small challenges. I'd say based on what you just told me.
absolutely. Yeah.
Yeah. So you hit, I mean, that's tough to try to scale a business during COVID, especially multifamily. Well, I don't know if it's actually especially multifamily. What can you tell us from there, and kind of where are you headed now? Kind of as we have a full circle moment, because that sounds like a big hurdle to overcome. Where were things on hold at the time? I mean, you think of this COVID is, was that, did that put the entire portfolio on hold, or what were you guys doing then? And then what is it that you're doing now to look in the scale and grow?
Yeah, I mean, at the time when COVID hit, we were just early stages of building the
Mm,
company, kind of early on. We were still building the infrastructure internally for acquisitions and asset management and investor relations and marketing. It was hard for us to build all of those departments, being a smaller boutique firm. So the decision we made early on was to partner with other groups who had a track record, who had done hundreds of millions of dollars of deals before, and bring in some of our brain power and some of our equity to some of their deals.
mhm,
And we closed on a few different deals with few different partners in different markets in Florida, in Texas, in the Carolinas, and gained the track record we really needed, proof of concept for our investors. And the company kind of got to a stage that we felt comfortable to venture out on our own. Brought
mm,
in on a different partner who hit our acquisitions department, which allowed for more deal flow. A partner that hit our asset management division, and so on. So we expanded the company a bit more after doing a few deals and started looking at deals ourselves. Now, we also wanted to be focused in certain markets. So today we're focused on Florida and Texas. In Florida, we're hyper focused on Tampa, the Tampa Bay market.
yeah.
Great city of 3.2 million people, has not only retirees moved there, but a lot of people moved there for jobs that are being created. The city is somewhat landlocked by the Gulf of Mexico, or Gulf of America, as it's known now. And yeah, I mean, it's a great place to be. I personally, I live just a couple hours south of Tampa, but it's a great place to be. So we currently own a property in the St. Petersburg market of Tampa.
Nice.
And in Texas, we're hyper focused on San Antonio. Now, we own an asset in Houston. That's another market we look at, but we really like San Antonio because it's really the sleeping giant, in our opinion. Every time you think about Texas, you think about the Houston, Austins, and
Mm,
DFWs. San Antonio always gets left out, but it's a city of 2.8 million people. It's got a professional basketball team, so much
mhm,
public and private infrastructure going in. If you drive through San Antonio today, you can see all these raised highways being built. I mean, the city is, you
mm,
can tell they're preparing for a huge expansion, and city officials usually have better data than a smaller firm like us does. So they're bracing for a huge growth in San Antonio. And yeah, the city is very affordable. So we're building a build to rent project in San Antonio, a 30 duplex project that we're building in San Antonio, 60 units in the
nice.
Helotes market of San Antonio. That's, yeah, CPI really is, we operate a integrated platform with two core strategies, one being multifamily value add, and the other is build to rent, um, building communities of purpose built rentals.
What does built to rent mean?
Build to rent, yeah, I mean, just briefly, build to rent is a process of building a community of purpose built rentals. In most cases,
Mhm,
there are single family homes built in a community of purpose built rentals. So it's not a for sale product; it's more of a for rent product. Now, the whole property can be sold, can be bought and sold, but the community itself is meant for rentals.
okay, so specifically for like renting communities, essentially.
Yeah, and really,
Built for rent.
it's a newer asset class under the commercial real estate umbrella. It really started post GFC, when Wall Street got involved in purchasing single family homes across the U.S.
Mm,
I mean, firms like Blackstone, they got involved
sure.
in the purchasing single family homes, and their thesis was that single family homes had gone up in price every single year from 1948 all the way up to 2009. And they felt that this was just a dip in the market, and the home values would come back. So that they just wanted to
Mm,
find a way of how to go out there and buy swaths of single family homes. They founded Invitation Homes. Blackstone did. They bought 50,000 homes scattered across the U.S.,
jeez.
and they took the company public. They eventually bought 85,000 homes. That's when they exited that deal, and they made tremendous returns for their investors. That was more SFR, single family rental, scattered business model, but they loved the business model so much that in 2013, 2014, that they could no longer buy single family homes for pennies on the dollar. They actually
Mm,
started partnering with developers and start building communities of purpose built
no way.
rentals. And the epicenter of this was Phoenix. So a lot of these purpose-built rental communities got started there.
And is that just due to the shortage of, what we're saying is, folks aren't buying as many homes anymore, so you need more inventory for them to be able to rent. Is it as simple as that, or?
That's one side of it, but build
Mm,
to rent really serves a different demographic. It serves the demographic of renters by choice, not renters by demographic. People who want to live, people who want to be mobile, either as empty nesters or
mm-hmm.
a young family or a young couple who want to be mobile, maybe live a few years in Texas, live a few years in Florida. They don't believe in this idea of the white picket fence home and live somewhere for 30 years
It's
for the
like the
rest of their
fire
lives.
movement.
Yeah, so they enjoy they like the idea of not having somebody living above them, below them, next to them. They have their
Mm,
own private garages, and rather than if you live in a rental home in a community, not a community but in a neighborhood, there's a stigma at times that comes with it being a renter in a neighborhood. Whereas if you live in a community of other renters who are all living in a single family home, there's no such stigma or concern either.
mm.
So it's a very interesting asset class and does done tremendously well. Our business model is a bit different. Our business model is actually pre-selling these duplexes to investors who buy them for cash flow, mostly
Mm.
California type investors who come to Texas to buy these duplexes for cash flow, and then our
So
investors
you
and
can,
CPI comes in.
okay. So you can almost liquidate them like if you were to buy 60 as you go, you get a return on them, right? Like you would build, let's say 60 of them, and then you could create like a turnkey situation where,
Exactly. That's exactly what we're doing.
yeah.
We're buying the land, entitling it just now as we speak. We're going to start going vertical over the next few months. Start pre-selling them before they're done. So add
Mm,
certificate of occupancy. The new owners get the keys. Our developer also has a property management firm. They're vertically integrated. They're going to start renting these properties out again, pre-rent them. So by the time their certificate of occupancy comes in, the tenants move in. So the
wow.
investors that are from California, they're making their cash flow day one between 500 and 1,000 bucks of cash flow per month.
Mm,
Our investors come in, the LP investors, the limited partners that come in, both Canadian and US, they fund the equity that's needed for this development
to
project.
build the whole thing, yeah. Let me
Build the whole
ask you,
thing.
because you touched on this, and I know gotten too deep into it, and I want to make sure I come full circle. You talked about when we opened up uh, the private institutional model back then. You talked about pension funds, and then you talked about university endowments, etc. Is the vision for CPI Capital? You let me know because you started, with the JV, and then you brought in some more partners, and now it sounds like you have limited partners. How much of those limited partners are essentially accredited investors that are giving you your money, and if that is the case, which I'll let you answer here shortly, what does it look like to bring in, like, I don't know, an insurance company or a university? Like, what is the difference between this game? Because it sounds like they're two different games and two very different sophisticated investors, two very different amounts of levels of money that you would get. So I'm just curious, considering you're so qualified and you're going through it right now, what does it look like today? And what would that look like? Do you even want to go in that direction? But help us understand like what it looks like to have like the that private institutional funding from these larger corporations.
Yeah, well, it all starts with that book right behind you, the book Traction, and the big, hairy,
Yes.
audacious goal
Yes.
of us owning 30,000 doors. That's kind of our big, hairy, audacious goal in 10 years to own 30,000 units and be on the list of NMHC top 50 apartment owners in the U.S.
What's
The
NMHC?
NMHC is the National Multi-Housing Council.
And why do you want to be on their radar?
That's the list of the largest apartment owners in the U.S. And they always
Okay.
every year they list the top 50 apartment owners in the U.S. on their list, and it's
Nice.
really more of a bragging rights to be on that
Yeah.
list. And the
Sure.
lowest number of apartment owners on that list today is 27,000. So as long as you own over 27,000 doors, you get to go on the list of the top 50. Largest one is Greystar. Blackstone is on that list.
You know what's
But
You know what's fascinating for a second, August? I just want to put some context. There's just so many levels to this because when you think about that, like, would a Grant Cardone be in that list, or he doesn't even make that list?
no, no,
Isn't
doesn't
that
make that list.
crazy? Like to think
No.
about though. Like you think of the layers of how big it can get, and that's why like a big hair audacious goal because it's just
Yes.
like there's so many levels to this, right?
That's right. That's right. Yeah. Yeah, I think maybe 5,000 doors or something he owns. But yeah, so 30,000 doors. So we worked it backwards. Hey, if that's the goal, we want to own 30,000 doors. We know approximately how much AUM that is, assets under management, which doesn't really count for equity or debt. It talks about the property's value. So how much equity do we need to raise to be able to own 30,000 doors by 10 years, right? So we worked it backwards. And then, okay,
Yeah,
sure,
what
we
is,
need to raise this much
can you enlighten
equity.
me? Enlighten me.
I don't have those exact numbers in front of me, but then we worked
Just
it backwards.
ballpark.
I mean, just do an average. So 150,000 a door times 30,000. So
Okay.
what is that? 30,000 times 150,000. That's, and then divide that by 3. That gives you the equity number.
Interesting. So
150,000 times
150,000
30,000 times 30,000 divided by 3. It's
divided
in
by
the
3.
it's in the
Oh,
billions.
oh wow, yeah, it is. That's yeah, that's 1.5.
It's probably might be more than that, or
1.5 billion.
is it 1.5 billion? Okay, perfect.
Yeah.
Yeah, so 1.5 billion. So if you're going to raise 1.5 billion of equity in 10 years, how much equity do we have to be able to raise on a daily basis? So when going back to the book Traction, they talk about the rocks, your quarterly rocks. So when you meet with your teams on a quarterly basis, how much soft reserves do we have to have, which equates to a proportion of that soft reserves ends up being actual investments? How many calls do our relations team need to have that many soft commitments? So it's kind of a backwards game, but we kind of realized that through retail investors, that was going to be impossible at the rate we were going. So the only way
Yeah.
to achieve that was to bring in institutional type of investors. Now, to leap over and try to bring in like a insurance company or a pension fund to invest with you is going to be pretty difficult. They have an investment committee. It's very hard to get them involved and come on board. But a smaller type family office or a
Which
smaller
starts
type,
at like 100 million, right? I mean, a lot of these family
exactly,
office minimum 100
exactly.
million. So
It is a very broad term. So one of the family offices that invest with us is a $300 million family office. They're a big group out of Canada. Another family office that invests with us, they're not technically a family office. They're just a wealthy group of guys that they invest in different products jointly. So we call them kind of somewhat of our institutional investors. But there's other investors
but
as
you're
well. We have,
cracking that door of like, okay,
exactly.
that so would you say, just to enlighten us, and then we'll put a bow on this because this is fascinating and I love the fact that we ended here, right? The big Herodesh's goal. If you're thinking, and maybe there's an order, maybe there isn't, so enlighten me because I don't know what I don't know. You start with private money, 50,000, $100,000 here, right? You're, maybe even, 506, B, and then 506C accredited investors, and then you make it 100,000. And then would you say the next step is, okay, now maybe you get a couple of family office, or maybe just some really rich people, right? Or whatever. What would you say then is the next? Like, you talk about like university endowments, which I had never even thought of. I definitely thought of insurance because I know that these insurance companies, I'm in this space, right? As far as insurance companies rent all of our real estate and as a temporary housing provider. So I know there's a lot of money there, right? They take their premiums and invest it back into the markets. I know there's big money there, but what would you say is like, if you're thinking of like a stepping stone of like, okay, after you knock on family office door, what will be the next door that you can crack open?
You keep in mind, it's not only the type of investors that we're talking about, going from retail to institutional, going from family office type investors to more insurance companies and other types of funds that come in, some overseas funds from Japan, from Germany, from other areas. Is also the vehicle changes as well. It might no longer be a single deal like a
It's
syndication.
a fun now, right?
It might end up being a fund. And then the natural evolution there is you go from a syndication to a fund to an open-ended fund to a REIT to a public REIT. It's the same process like a Sam Zell
Oh,
of the
that's the
world.
evolution.
That's the
Okay.
evolution. Yeah. Goes from
Real estate
a
investment trust.
single deal, joint venture, syndication, close-end fund, open-end fund, REIT, public REIT.
Boom. All right. So Next time you come on the show, I'm gonna have you at the public REIT. We'll just circle back that. We'll put a bow on it. The next time you step onto the show, you're gonna be explaining to us how the REITs are established and packaged together. By the way, just so I always have a peak of curiosity. REITs, from what I understand, do those end up being public real estate
There you
investment
have both.
trusts?
You have both. You have
Okay,
public REITs and private REITs. It's
interesting,
just a vehicle.
interesting.
It's just a vehicle. Public REITs, you can, people can go online and literally invest in your deal and creates liquidity. You can sell it anytime you want. They behave just like a stock.
Mhm.
Private REITs, you have redemption restrictions, so they could be paused by the fund manager to not allow for certain redemptions.
Mm.
Private REITs, so they're not on a stock exchange. They're usually their redemptions are not as liquid as a public REIT. But it's just a different vehicle than, let's say, a fund. Funds are usually structured in a limited partnership. REITs are real estate investment trusts.
I love that. I love how you keep saying it's a vehicle because I have a good friend that says, Ruben, it's just numbers on a paper, right? Uh,
Okay.
so listen, thank you for bringing this to a landing, August. Like I said, we're gonna put that into the universe next time you step into this lab. I'm sending you and CPI Capital abundance, great deals, great returns for everybody, great lessons, great insights your way. And I can't wait to have you back here next time we step into the lab. But you talked a lot about being a thought leader. I think your name stands alone, August Biniaz, my brother. So, how can the rest of the individuals here who are listening tap in with the amazing empire that you're building? With again, you're just getting warmed up. It sounds like we're just scratching the surface, which is super exciting to see in a business like yourself that's growing. But where can people tune in and stay in touch with you, being the thought leader that you are, and not only talking the talk but also walking the walk?
Of course, yeah. I'm very active on LinkedIn. August Biniaz on LinkedIn. I'm a LinkedIn top voice, invitation only. Let me brag it a little bit. Check out our website, cpicapital.com. And we have a podcast as well, Real Estate Investing Demystified. Check us out there. Yeah, check me out on LinkedIn. Say that you saw me on the show and love to connect and chat about all different topics.
That's awesome. And like I gotta ask you because I'm super inquisitive. How do you get LinkedIn top voice? I saw
It's
that
an
on there. It was
invitation
very
only.
impressive.
Yeah, it's
Okay,
invitation only.
boss.
So yeah, as long as
What
you're
does
out
it
there
take? You
creating
got 23,000 followers on
That's right.
LinkedIn. That's amazing. What's the quick? You're a marketing guy. What's this? What is the thing that you're doing right now that is really working for you for someone who's an aspiring thought leader? We talked a little bit about marketing, but what is a nugget you want to leave for to establish deep roots the way you've done so in person with your credibility, but also on social?
Yeah, it's really consistency. That's key. You got to be consistent, creating a lot of content, for your niche audience as well, for whatever it is that your expertise are. So don't be too diverse. And then for LinkedIn in particular, when you first start, it actually allows you to upload your contact list and automatically sends everybody a message. So it doesn't give you a limit in that first when you first start out. So you can upload a contact list and get a first boost. Another great feature that LinkedIn has is LinkedIn newsletters. The SEUs are really powerful. So as long as you write, regular newsletters, that will be on the online, and people will read your newsletter and they'll start following you. A lot of videos on LinkedIn works great. Keep in mind, a very small percentage of LinkedIn users, around only 5%, post regularly. So it's a lot easier to get noticed on LinkedIn than it is on other social media like
Less
Instagram, and
noise. People are
less noise.
consuming more than they're posting.
Exactly. And yeah, people are just business people. They're not used to posting. They're used to just, focusing on their craft. So you get noticed a lot. And then there's not also a lot of distractions. Whereas on Instagram and Facebook and TikTok, you have lots of
Noise.
I would call
Noise.
it distracting noise. Yeah. So but on LinkedIn is
And the
not. So you do
algorithm
get
will
noticed.
throw anything at you and send you down a rabbit hole, whereas this is very, you know,
Exactly.
what you see is what you
Exactly.
get. That's rich. Thank you for sharing that. And I know I have you locked in here on LinkedIn, and I'm gonna be following every move until I see that REIT thing go up, man. But until then, let's enjoy the journey, and look what you've achieved is as admirable. And um, congratulations. The best is yet to come, my friend.
Thank you, my friend. Thanks for having me.
Absolutely. An experimentation just like that. We are out.
Experimentation, I believe there are two critical components that will help you achieve your goals very quickly and succeed. Number one, it's information like this that you received on a show, in an episode, and content that you can find on my YouTube channel or anybody's channel. And then there's a community. And the way we've been able to expedite our process, the way people in our community, who are people that we consult, mastermind members, whoever, they get the information on an episode like this, but then they also have a support, whether it's me guiding them or being guided through a community. There is an opportunity for you listening to be able to expedite your process or even expedite your results that you're seeking by being part of the community. If that is what you're interested in, we at Experiment Nation happen to have a community devoted to helping maximize your occupancy and your profitability altogether, regardless of which market that you are in. And for that reason, you have an opportunity where you can go to experimentrealestate.com/submit if you're looking to work in an environment that can help you prosper faster. Call out any areas that you might not be familiar in, especially the blind spots. That's where a guide comes in hand, and I would be a pleasure and honor to be your guide. But in order to make sure you're a good fit, make sure you go to experimentrealestate.com/submit so that my team can go ahead and take it and see if you're a good fit to join the mastermind and the multiple programs that we have. In addition to that, I'm also now a YouTube partner, which means that I want to give you more access to information, more access to Q&As, more access to the questions that actually come out of our mastermind to help people expedite the process. We've seen people get anywhere from $4,000 to $5,000 to $6,000 to even $7,000 a month net on just one door by applying the strategies that we use by working with corporations and furnished accommodation in a very strategic way. So if you're interested, make sure you also subscribe, because I'm going to have different tiers that's on YouTube now that we've become YouTube partner, to continue to be the bridge to your success in your lab. And your lab means your life, your goals, or wherever you're trying to head. So make sure you also hit the subscribe button on my YouTube channel. That's youtube.com/real estate experiment. We'll be there. You can also look us up at Midterm Rental Insurance Experiment. We will be there. Make sure you hit the subscribe, because that's when you'll know the tiers that are available to you that make sense for you, your marketplace, for your results. Remember, you're only one experiment away. Let's build.